What a day. Apparently, one piece of U.S. inflation data that was hotter than expected was digestible, but two was a bridge too far. That's what we're going to be focusing on today on Macro Money. I'm Elias Spivak, head of global macro here at tastylive, and we are going to unpack what happened here today because as we've been monitoring the impact of this U.S. economic data on Fed policy expectations, and then, of course, the implications of that for the markets, today seemed like a bit of critical mass was reached. And, of course, now we line up for the last big piece of notable data to hit the wires over the course of the span between where we sit at the end of this week and next week's all-important Federal Reserve policy announcement, where the crystal ball might get shaken, the snow globe might get turned upside down, and things might change entirely. So we're going to unpack what's been going on. We're going to see how it's been impacting markets and establish some baselines for what is probably in view to come. So the key question that is on our mind here is, of course, are we now in the danger zone for stock and bond markets? Because the price action that we saw today was clearly showing signs of some liquidation. And the catalyst for that liquidation was, as one might expect, diminishing Fed rate cut odds. So let's see what we ended up with. This is a tally of today's releases, and the one that we were actually looking at as a possible catalyst was retail sales, but that one ultimately landed on the disappointing side of expectations, despite leading data suggesting that maybe we would actually end up with something that was much more chipper if leading PMI data was to be consulted. As it turned out, not so much. So here's that retail sales report. It registered weaker, 0.6% than the 0.8% expected. The number for January was revised down from negative 0.8 to negative 1.1%. So the general the general direction here hardly encouraging, but this was ultimately not where it seemed like the attention from investors was really pointed. Rather, it was the PPI report, the producer price index data, and here you can see a sharp jump relative to both the prior month's results and expectations. 1.6% on the wholesale inflation rate. This is the producer price index. So what this measures is the price of finished goods as faced by wholesalers that then send that stock off to stock shelves, and of course consumers then face their own sticker that is to some extent marked up by retailers, by sort of end demand venues wherever they're buying things, be it online or in stores. And the expectation generally, although there isn't certainly a one-to-one relationship between the PPI and the CPI or the PCE measures of consumer-faced inflation, there is the expectation that when you see buildup in wholesale prices, what's going to happen is when you get to retailers, they are going to pass that on to consumers. So because wholesalers pay higher prices, They don't necessarily eat all of that. They pass that on, and consumers then end up facing it, which of course impacts the key measures that are targeted by the Federal Reserve, which is still attempting to bring consumer-facing inflation. They define that in terms of the PCE index, the personal consumption expenditure inflation gauge, down to 2%. So that we saw PPI surprise here was certainly eye-catching for Fed policy expectations. So 1.6% here, much stronger than the 1.1% expected, and the 1% from the prior month. If we look at the core reading, the one that excludes food, energy, and the impacts of trade, we find 2.8%, much hotter than 2.6 in the prior reading. And as though to add insult to injury, we also got a little bit of a soggy view on the situation as it looks in jobless claims, although it wasn't it wasn't especially awful, but we can see here no real improvement week to week on the 4-week average. Initial claims a little bit lower than expected, but if we look at continuing claims, they came in a little bit higher than the prior week, although slightly better than expected. It was that PPI report that seems to really speak to the price action, of course, and here the impact is unmistakable. Stocks down, although meaningfully off the lows. They were down much more in the wake of the PPI report and seemed to claw back some lost ground in really the final minutes of the session. But the general direction of where markets were heading is seemingly unmistakable. All things that don't yield anything, in other words, those things that might look less attractive with inflation data nudging Fed rate cut expectations lower and bidding up yields, as we see here, strong rise across the curve, the 10-year up a lot, the 2-year up a lot. The counters to that, the sort of natural foils to that, absent, of course, bonds themselves, which move inversely of yields and so are necessarily down as yields rise. Gold, which yields nothing, down. Yen, which yields nothing, down. Bitcoin, which yields nothing, down. So strong declines really across the spectrum of assets sensitive to what interest rates are doing and what the Fed policy outlook might imply for those interest rates going forward. Crude oil was a bit of a standout here. It seemed to be marching to the beat of its own drum, rising 1.8 almost %. But everything else really taking in this view that with this stronger inflation numbers, the second time this week now, we are going to be looking at fewer Fed rate cuts than earlier anticipated. And we can see that here. So let's review this logic. So this line here, obviously the S&P 500, which is a kind of a benchmark for risk taking, for risk appetite from investors. And the gray bars right here, the stock of interest rate cuts that are expected from the Federal Reserve this year as they are priced into Fed funds futures. So what we've argued here is that it made sense for risk appetite to be well supported when the Fed was either expanding scope, or at least the markets thought the Fed was expanding scope, for rate cuts, and as long as there was a positive gap between market expectations and the Fed's baseline. So consider here, as we get into the November and December FOMC meetings right here. In November, right at the start of the month, the Fed starts to say, okay, we feel like we've reached the peak in the rate hike cycle. We feel like we don't need to go higher from here. Obviously, we will if we have to, but we feel that we're essentially done here. And what that sets the stage for is interest rate cuts to follow. Against that backdrop, we see that the outlook for Fed rate cuts on the menu for 2024 begins to move from about 60 basis points, so a pair of cuts with some optionality for a third, but that optionality suggesting that a third cut is modestly less likely than a 50-50 shot, something like 30-40%. One cut, of course, standard sized, is 25 basis points, so two of them is 50. 60 would imply that 10 basis points of a third 25 basis point cut is being baked in. And if we sort of do the math on what the probability there is, that amounts to about a 40% chance of a third cut. As the Fed starts to change its tune to a more dovish setting, this starts to build out. And against that backdrop, stocks understandably move higher. The idea being cash is going to be cheap, credit is going to be cheap, more so in the future than now. And so it makes sense to take market risk. It makes sense to send cash to chase returns because the actual return on that cash will be diminishing, whereas the cost to borrow back that cash, if it is lost, is also falling. And so it starts to make sense from the market's perspective to say, okay, well, if credit is going to be cheaper in the future and the return on cash is going to be lower, it makes sense to start deploying assets further out on the risk spectrum and chase those returns. Not doing so starts being a hurdle to investment performance, and the risks associated with doing so are inherently diminished, not because you're less likely to lose money if you get things wrong, but because if you lose it, you can then get liquidity back, get cash back at diminishing borrowing costs in order to go again. So, not surprisingly, as this begins to occur, stocks rise. Now, in December, the Fed comes out and says, right, okay, here's an official set of updated forecasts. We now are looking as a baseline for 80 basis points in cuts in 2024. Let's consider what that means. So 75 basis points or 3 cuts are fully baked in at that point. And then the rounding error here, the 5 basis points between 75 and 80, if you want to consider that less of a rounding error and an actually thought through addition, although the Fed reports forecasts out to one decimal place, so there's no telling whether they actually meant to be over 75 basis points or they just rounded, comes out to, in any case, a paltry 20%. So the Fed is basically set with the December forecast at 3 cuts for this year. The market, of course, takes the forecast much further. And by the turn of the year, they're looking at down 150 basis points. That's 6 cuts. At one point, it even spiked in the direction of 7. So what we're looking at then is a very potent tailwind for risk sentiment. The market's essentially reckoning the Fed's going to have to come our way. And if we didn't think that, of course, that wouldn't be what is priced into the futures. So clearly the markets are anticipating that the economic data is going to be worse than expected, that disinflation is going to be faster than expected, perhaps some sort of economic downturn is on the horizon. And that starts to really open up this gap right here between where the market thinks rates are going and where the Fed thinks they're going, which is this green line at 80 basis points. And that, of course, is a very strong impetus to push capital into stocks. But then as the year begins and economic data starts rolling in, it's actually better than expected more often than not. We can see that in this index of U.S. economic data outcomes relative to expectations from Citigroup. Here's the beginning of the year, and we can see that the data is increasingly outperforming and by a larger margin as time goes on until we get to about mid-February. And against that backdrop, not surprisingly, the stock of rate cuts in the forecast begins to diminish. Again, until we get to about mid-February, right around here. But of course, from the market's perspective, as long as we're under this 80 basis point benchmark, the market is still expecting cheaper money than the Fed is actually calling for. And in this period, since the December Fed officials come out, they continuously kind of reiterate this idea the December forecast is still good. We still expect about 3 cuts, maybe 2 to 3, but generally speaking, we continue to see the situation as we had it. So the 80 basis points remains valid. And as long as there's this gap between here, and there, the money in the future still looks like cheaper of a thing than money today. And so the tailwind to risk appetite continues to push even as rate cuts diminish until we get here. And what we find is that now we're actually nudging on the wrong end of this 80 basis points line, and we're starting to get to a place where we're flirting with the idea that 3 cuts might become less likely than 2. For now, we're still at 67 basis points today, which is the lowest that we've been in 2 weeks on this rate cuts outlook. We're still slightly more tilted toward 3 cuts. So if we consider that between 50 and 75, there's 25 basis points, and between 50 and 67, there's 17 of those basis points already baked in, then what we're looking at is about a 68% chance of a 3rd cut. So we're still just barely holding on to where the Fed outlook had us looking. We're still slightly holding on. If that number went to negative 61 basis points, though, we would flip into a world where the market is saying there is the 2 cuts baked in, but now there is a less than 50% chance, or worse than even odds, that you'll get that 3rd cut. And at that point, the markets will have essentially become overtly more restrictive, overtly tighter on their settings for the cost of credit than the Fed benchmark forecast as it established in December. And of course, next week, we're going to get the next FOMC meeting, and it's going to be one of those big quarterly ones where you get updated forecasts. So the benchmark may well move. The fear, understandably, might very well be that the Fed will revise its benchmark to 2 cuts, because it surely isn't lost on the Fed that the economic data has in fact been good, and that it's not, of course, only this surprise here, the relatively surprising number here, hotter than expected, and of course this one, much hotter than expected. But earlier in the week, CPI, likewise hotter than expected, and by a decent margin. 3.2 on the headline, 3.8 on the core, against expectations that were lower on both fronts. And it is with this in mind that we then look to what is the next critical piece of data, the University of Michigan Consumer Confidence Survey. Now, this has become very important and often now market moving over the past several years, because as the Fed in 2021 was still saying inflation post the pandemic is a transitory thing, as supply chains normalize, it will go away by itself. It was this survey that really screamed with its one-year inflation outlook, no, inflation is sticky, and the Fed is going to have to do something about it. In fact, what we see here from the most recent situation here, you can see that from the beginning of 2021 into the middle of the year, this sharp build in inflation expectations, and then, of course, the sharp decline in measures of consumer confidence, be it the baseline sentiment index or the constituent measures of confidence in current conditions, as well as forward-looking expectations for where the economy is heading. So as inflation expectations rise, you can see here they start to peak over about 5%. So too confidence unravels. Now, right around here in early 2022 is when the Fed starts to raise rates. And you can see that as that pushes back on inflation expectations, sentiment improves. So there's obviously not a straight line here. There's been spikes along the way, but as the trend generally is toward lower inflation expectations, so too consumer confidence has firmed. We saw that it dipped a bit in the February survey here, as inflation expectations unexpectedly jumped from 2.9 to 3% on this one-year outlook. Now, what we've just seen this week is weaker than expected retail sales and two major inflation gauges north of forecasts, CPI and PPI. If this is going to reflect that, as opposed to these baseline forecasts for standstill, you can see the measures of sentiment expected to come in essentially unchanged, the inflation forecast expected to come in unchanged at 3%. If the data we've seen already this week is going to tell us, well, actually, inflation expectations are higher and sentiment is weaker, that would only push back Fed rate cut expectations further, because it would say to the Fed, look, inflation expectations are still a big issue for consumers. And of course, consumers are the quintessential driver of U.S. growth. So if you want to land the plane here softly, if you want to beat inflation without breaking the economy, you need to back away from at least some of these rate cuts, or at the very least dilute them enough in the minds of the markets and in the minds of consumers and in the minds of investors that inflation expectations stay anchored. So if inflation expectations rise and consumer confidence falls, the view might very well be, okay, well, that perhaps takes us still further in this direction, because rising inflation expectations and its echo into poor consumer confidence and then into poor retail activity bodes ill for growth. And the Fed will not be in a position to cut if it's inflation hurting growth, and inflation is the thing they're supposed to be fighting. So if that nudges this further and actually arrives us within vicinity of that 61 level, where the third cut becomes less likely versus more, well, then the implications for risk taking might very well be dire. Bonds may decline as yields rise, but most critically, the tailwind that we've seen from this dynamic might turn into a headwind, because now money in the future is going to look more expensive than money now. That might encourage a push for cash, and so liquidation of risky assets, and push down stocks, and push down other risky assets as well, like Bitcoin, like risk-sensitive and cyclically sensitive commodities, and lift the US dollar, even as bonds decline and yields rise. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I usually co-host with Chris Vecchio and Dylan Radigan, except today, of course. Both Chris and I are kind of under the weather today, so we gave up our seats on that show. We expect to be back tomorrow, as we do every Friday, for Futures Power Hour. We'll be back on Sunday for First Call with Tom and Victor. I'm also writing for the news and insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Happy trading.